Welcome back, everyone, to another edition of Assets and Taxes. I'm Kent Fitzpatrick, your host today and managing director here at Asset Strategy. And with me today is my colleague and friend, Mike Underhill from Cantor Fitzgerald. Hello, Mike.
Pleasure to be here.
Thank you for joining us. Let me start by giving a little bit of background on Mike and our topic for today. So Mike is the CEO, CIO, and co-founder at Capital Innovation and portfolio manager of the Cantor Fitzgerald Infrastructure Fund. He has more than 30 years of experience specializing in infrastructure and real estate investing. He previously held senior investment roles at AllianceBernstein, Invesco, Janus, and Lehman Brothers. He authored the Handbook for Infrastructure Investing and has served as Chairman Emeritus of the United Nations Infrastructure Workstream. So thank you, Mike, for that. And to give you a little bit of reference on the relationship between Capital Innovations and Cantor Fitzgerald, Capital Innovations serves as the investment sub-advisor and makes the portfolio management decisions. Cantor Fitzgerald sponsors the funds, provides the interval fund structure, distribution, operations, compliance, and oversight. The partnership combines Cantor's institutional platform and Capital Innovation infrastructure expertise. So with that, infrastructure, this is our topic today. So for listeners who are new to this topic, what is infrastructure investing and what qualifies as infrastructure?
Well, I think thank you for this time and for an examination of the asset class, because I think 33 years in this business. I started out as a sewer bond analyst in 92 at Lehman Brothers, and now we're in 2026, and we've seen the IPO of SpaceX, which is really an infrastructure play if you look at the power and energy and all the other things. So we've gone from sewage being unsexy in 1992 to now sewage is sexy in 2026, right? Yeah. And now in power and energy, doing this over 3 decades, it's interesting to see because infrastructure is an asset class. If it was a Hollywood actor, we used to look like Zach Galifianakis in The Hangover, short, pudgy, bearded. The girls would walk the other direction.
Yeah.
And now infrastructure in 2026 is all about the picks and shovels that support AI, power and energy and digital. So if we were a Hollywood actor today, we look more like Brad Pitt in Ocean's 11. At least that's what my wife says.
Yeah.
So I think it's a bit more sexy today. And you're seeing investors, institutional investors that are really leaning in, making meaningful investments in infrastructure. And in the way that we look at things today, investors can be defined by 3 big megatrends. If we were to take a look at some of these megatrends, think energy transition and addition. So think about brown electrons, green electrons, hydrocarbons, renewables, power generation, power transmission, battery storage.
All the things that AI is gobbling up.
And to your point, so November 30th of 2022, ChatGPT was unleashed on the public, and immediately it started consuming 3.5% of electricity in the United States. 3.5, and that was post-22. And present day, AI's consuming not 3.5, 7% of electricity.
Double.
And by 2030, AI's forecast to consume 15% of all the electricity in the U.S. And I put together a chart for you, just for context, on electricity prices and inflation. And there's about a 0.994 fit of electricity to inflation, right? So investing in things like that, it's a pretty good inflationary hedge. Now with the inflection point and electricity prices going up, and you're starting to see some things going on with AI, this insatiable need for power, energy, electricity, the investment space is growing beyond electricity, beyond power into digital, and some of the other mega trends that I'll touch upon. The second big mega trend, digital transformation. Data centers, cell phone towers, fiber, satellite operating companies, which are now real time with Starlink. And now you can get on your plane, you can actually fire up your laptop and actually have Wi-Fi, and it's powered by Starlink. And who would have thought that 5 or 10 years ago?
Yeah.
And you look at data centers, right now, the United States is the #1 country leading the AI race with data centers. According to Stanford's Artificial Intelligence Index, the United States has 4,342 data centers.
Compared to China, less than 400.
Less than 400. Germany's #2 at 811. So we have almost 5,000 data centers, and we're building more every day. And the constraining fact is not.
But I wonder, from an infrastructure play, what percentage of our 4,000 are hyperscale capacity versus, Europe or China?
So you're seeing double digits clocking in around 40, almost 50% hyperscale. And you're seeing sub-hyperscale, carrier hotels, small, sort of converting a bank or converting commercial office property into these smaller data centers, in which it's better for some of the rural, some of the towns with less than 40,000 people, where the large-scale data centers aren't necessarily viable from an economic perspective. But we're seeing more development, and with all of these data centers, co-located power, gas-fired generation, solar, battery storage, and you're even seeing a movement at the national level where Christopher Wright, Secretary of Energy, is saying we need an all-of-the-above approach. We need brown electrons, green electrons. We need battery storage. We need to throw everything at this problem because AI is consuming electricity. We need data center support. We need co-located power. And now the regulatory authorities are dealing with the Department of Energy, and they're saying consumer prices are going up for electricity. How do we address this? Now data centers are now mandated to bring power alongside their data centers and battery storage so they can negate some of the increases of electricity prices.
Interesting, the announcement with Chevron partnering with Microsoft for a facility in Texas, right at the source, right?
Absolutely.
Before I jump into my next question, you had three. So you had energy transformation, digital transition, and what was your third?
Enhancement of aging infrastructure. So think about American Society of Civil Engineers. Their estimate is we have to invest roughly $3.4 trillion just to take the infrastructure in the United States from a C-, which is their American Society of Civil Engineers report card, a C- student, not passing, just to a C. 3.4 trillion, airports, seaports, toll roads. The FAA system is 50 years old. So every time I got on an airplane, yesterday I flew into Logan Airport. Before I took off, I said 2 Hail Marys and an Our Father, because that FAA system is 50 years old. I really hope it works.
Yeah.
Right?
Yeah.
But hope's not a strategy. Denial's not a river. You're seeing the Secretary of Transportation, they just implemented a $4.50 user fee to help pay for a new FAA software system. And now they're starting to implement other user fee pay models to start paying for some of these airports to hopefully provide some financing mechanism to start building a base of capital to help finance and invest in this infrastructure.
Do you think AI and certainly AGI, which some say is only a few years out, will help solve some of that? Because obviously some of those systems are so ingrained in legacy technology and all the rest of it.
Absolutely.
Yeah.
We're going to go from Gen 1 to Gen 3, or maybe software model 1.0 to 3 or 4.0.
Yeah.
And leapfrog with technology so we can solve for a lot of these things. And I think that's what the Transportation Secretary, he was hinting at the fact we can use AI and AGI and really try and turn things on its head, because it's a question of the science and the systems and the tracking and logistics. We can solve for this and debottleneck the system and have better, safer air travel, better, safer airports, where you're starting to see in the last 2 years, you're having some of these incidents where airplanes are clipping each other at LaGuardia, at Kennedy, some of these other things. So it's about safety, compliance, efficiency, and better travel.
You touched on it before. And I think for our average listener or viewer, when they think the word infrastructure, they think of crumbling roads and bridges. And we saw that collapse in Minnesota several years ago. I think every time I go over a bridge, I kind of hold my breath, to the same analogy of jumping on a plane. So, AI can't necessarily help the physical aspect of infrastructure. I mean, obviously, when bots are here, maybe that's going to help some of the labor pool. But I think the software problems, AI could probably be a quicker fix. But I mean, so for the average investor, I mean, it's not just bridges and roads. You talked about energy, you talked about infrastructure, and I think I'll share this too, that some of our friends in the oil and gas sector, which is really what's powering our energy demands today, it's not wind, it's not solar. They say bring on every alternative energy that can create an electron, because the capacity or the demand is not slowing down globally. So for a why is infrastructure such an important asset class from an investor standpoint today? And maybe touch on what elements within the infrastructure lane, because we've thrown a lot for our viewers, that you like to focus on.
Yeah, I think if you look at the raison d'etre, you look at the reason for investing in infrastructure, it's a long-dated asset class, monopoly positions. Think about trying to replace an airport, a utility, a data center, a cell tower. 20 to 30-year contracts, power purchase agreements, in some of these power agreements, long-term contracts with data centers. The income that's coming in is inflation protected. These contracts have CPI plus 300 or 500 basis point escalators in the contract. So think about investing in an asset or a series of assets, an asset class itself, infrastructure. We've got alternative income that's inflation protected with monopoly-like companies and operating platforms that whether you're in a financial recession or depression, people continue to flush their toilets and take showers. So downside protection, that's very durable income that's inflation protected. And it's proven out over the last 50 years, whether you're in a 1999 tech wreck or the 07, 08, 09 GFC, or even COVID swing of 2020, infrastructure has held up, private infrastructure, incredibly well. Very little loss. It's never going to generate these wild returns like these traditional AI or chip or tech plays. But the pension funds, endowments, foundations, sovereign wealth funds, big $500 billion, trillion sovereign wealth funds, they're increasing their allocation from 5 to 10% of their portfolio because they get all of these wonderful attributes of infrastructure and very little correlation. Said another way, private infrastructure has about a 0.17 correlation to real estate, 0.16 correlation to private equity.
Yeah. Right. So for a diversification standpoint, it's not a bond surrogate or an equity surrogate. It's probably in that alternatives lane. So the old 60-40, balanced portfolio stocks to bonds is probably more like a 50-30-20 allocation. Maybe it lives in that 20 along with other uncorrelated assets like real estate, as you mentioned.
Correct.
Okay. All right. Yeah. I wanted to go back. You made a reference to kind of the start of not the internet, but the start of Anthropic and Claude and all the AI tools in 2022. Your fund with Cantor is fairly young. But you started in 22. Was that just coincidence, or were you guys kind of seeing that this is a play, or maybe that's a Cantor management question? But it seems ironic that you guys kind of launched as we were just getting started with this AI race.
So the model and blueprint for this fund has been on the books for 10 years. We took it to various groups, sponsors, talked to various large investment houses. And the conversation with Cantor was such that they identified and saw what we saw and looked at our team and our process and our philosophy and our track record of performance for the last almost 20 years and said, interesting, you can blend infrastructure in both public and private markets, wrap it with a structure like an interval fund where it's daily pricing, quarterly redemptions for up to 5%. You can invest in publics and privates where, for example, in nuclear energy, there's little to no investment opportunities in private nuclear energy. Conversely, in public markets, you've got Vistra, Constellation, NRG. So it's a completion strategy, total portfolio approach, and showing some anecdotal evidence around some of the more sophisticated investors have blended roughly 70% private, 30% public. You get a better risk-adjusted return, Sharpe ratio, better outcome without sacrificing liquidity. And it's a perpetual investment vehicle that throws off highly tax-efficient income that's durable, as well as some pretty attractive capital appreciation.
And I want to drill in that a little bit further because not all of our listeners or viewers may be familiar with interval funds. So I guess the advantages or disadvantages over, let's say, an infrastructure or utility ETF or mutual fund versus your interval structure. I think you probably answered the question, but I want to just push you a little bit more.
Well, no, that's when you look at the structure itself, it lends itself to a longer-term investment time horizon where there's windows of liquidity, we can invest in private market assets that have longer dated contracts and it's a longer dated thesis. But admittedly, because it's private markets, the volatility is significantly lower. If you were to look at, for example, this fund, April of 2025, when we had Liberation Day, U.S. equity S&P 500 was down 13%. This fund was down negative 1.12, right? So downside protection. So you can invest in a utility ETF or some of these global thematic AI ETFs. Sure, you're going to be...
But it's only public.
It's only public. So you're subject to some significant volatility, of which if you're willing to accept the volatility, knowing that when they work, and when they don't, the sector funds typically go out of favor. This is more of a durable investment thesis around private plus public and optimization for a certain series of assets.
What's that blend right now between public and private in your fund?
So right now, 74% in private if all the capital called today. So we're right in the range-bound allocation.
And does that require you to hold a certain amount in cash, for redemption purposes?
So typically we're anywhere from 5 to 7% in cash.
Okay.
The listed infrastructure that's in there works as a capital call facility. It's alpha generation, but lets us generate returns, but we can sell it down and draw down on it to fund our private commitments. We have, in the first quarter, we had three private commitments. We had a co-investment. We had an APAC Energy investment. We were able to draw down residual cash, but the majority of it came out of listed infrastructure, and then we could be liquid by lunch, sell those securities, fund the capital call, and everything works very efficiently.
So what are the 5 major infrastructure categories that you're invested in currently?
So it's within power and energy, it's hydrocarbon and renewables, power transmission, generation, and storage. Right. So we really look at it according to these 3 big megatrends. So there's a couple segments, verticals there. Within digital, it's data centers, cell towers, fiber, and satellite companies. And we can do equity and debt in private markets, and we can try and find the best opportunities, to your point, whether it's hyperscale, sub-hyperscale, data center, small cell towers. We did a portfolio of small cell towers, and we invested in them in April of 24, January 25. A portion of those towers were actually bought in private markets from American Tower. So we've seen some real interesting movement in a liquid private markets, despite the fact that it's supposed to be a 10-year time horizon.
Now, I heard you say private credit, lending capacity. Are you restricted on how much you can allocate to private credit versus private equity within the fund?
We have range-bound allocations. Right now, we're running at about 20% of the private allocation is to infrastructure debt. And so it's private credit generically, but when you look at the actual assets, the loans within our private credit vertical, data centers, cell towers, fiber, B2B, edge co-location. We did do some debt within renewable energy, solar, and you're seeing yields of 9 to 11%. You don't see these really high non-asset-based loans that are in the 15 or 17%, right? So we'd much rather have a 9 or 11% yield in private credit that's backed by durable assets with long-term contracts. And we have a tendency to focus on fixed rate debt as opposed to floating rate debt.
So we talked about data centers, fiber networks. What do you view in the next 5 years? This is going to be a curveball to you. The next 5 years, because I referenced AGI as Kurzweil talks about it coming in 2029. I think that's going to change everything. Do you see any short, intermediate, or long-term impact as a fund manager in the infrastructure space of the possibility of where AI is going? And I'm sorry, I know that's a loaded question.
Yeah, well, I get it is. But there's so many different ways we can vector with this, right? And I think in the 1 to 2 year time frame, we need to address the shortage of electricity. And so we've put together our mosaic investment thesis around speed to market on power, where solar and battery storage takes 1 to 2 years. Natural gas takes 2 to 3 years. Onshore wind takes 5 years. Hydroelectric, 5 years. Offshore wind, 5 to 10 years. Nuclear, 10 years. That gives you an idea from when this shovel strikes the ground to the time you're powering up and generating power to support this electrical consumption from AI. That leads you to the thesis around what's going to get funded. So we just did 2 renewable partnerships in the last 6 months, and we see 2 ways to play renewables, both in the U.S. and abroad. There's a distressed renewable cycle where when interest rates went up, you had a lot of government money that was funding these unprofitable, economically viable renewable developers. Now we're sort of 4 years into the cycle, interest rate cycle. It's wrung out all the opportunity. The developers are going bankrupt. So there's a distressed renewable cycle that we're seeing, and just made some investments there. On the broadly in natural gas-fired generation, there's a shortage of turbines. Finding turbines in the secondary market is a today, this week, this month, this year, next year problem that the CEO of NextEra Energy said, I run a utility company, one of the biggest in the country. I can't get gas-fired turbines.
Yep.
We invested in a platform last year that actually uses recycled airplane engines, and those are the engines that they're using for gas-fired generation and repurposing them, and they're getting them from planes that are sitting in the Mojave Desert and collecting sand.
Well, I'm hearing the same in the BESS, the battery energy storage system space. Most of that is coming out of China just because of the minerals that are required to produce batteries. Batteries can't be found. So if we want to store that energy, that's another headwind.
You've got a rare earth headwind. And that's why the other thing that's complementary to the battery storage story is geothermal. And I think what you're seeing more of is co-located geothermal in places like Pennsylvania and Texas, where there's a preponderance of shale and coal, and think about all the activity. And they can have geothermal in which you have a data center located on top of a vast store of natural gas, like that deal you just saw.
Yep.
The data centers here, you don't have to build pipelines to carry the gas, turbines for gas-fired generation, battery storage co-located. Small modular reactors then are brought online within 5 years, and they're doing this at University of Texas, Texas Tech, and Texas A&M, and they're building what's called energy parks co-located with data centers. That was discussed last summer at that big energy and infrastructure confab in Pittsburgh. It was Carnegie Mellon's artificial intelligence department and robotics. Google, Facebook, all the big tech companies were there. Energy Secretary Wright was there. Dave McCormick was there. And now they're doing a 2.0 meeting. It's July 15th next month. And they're doing it at the U.S. Army War College because they're incorporating an infrastructure along with sovereignty and national security.
Interesting. Well, we're also seeing the use of microgrids for conditioning the power, because I think a lot of people don't understand that the electrons that come through the utility, it's not just blackouts, but it's grayouts and brownouts because it's inconsistent, and that ruins, these very expensive, fancy NVIDIA chips. So the conditioning is also another bottleneck to the infrastructure.
So to your point, that conditioning challenge is real time, and for any of those that read, so Spain, they had a national blackout because of the challenges and the conditioning and the fragility. And these NVIDIA Blackwell chips, they will overheat if the data center doesn't have enough cooling. And oh, by the way, 20% of the electricity that data centers use is for cooling.
Yeah.
Right. So there's a conundrum there as well.
Well, let's talk about cooling as that end of the infrastructure, because I know there's been a lot of battles with Mr. Wonderful, who's obviously investing in a hyperscale big project. I can't remember if it's Ohio or Utah where that's located, but what he was finding is that, and again, I'm not picking a side here, but local people saying, not in my backyard, you're taking our energy, you're taking all of our water, all the rest of it. A lot of that is propaganda being funded by China. What's your take on that? Because obviously they are losing the race right now, and so any headwind they can give us to slow down our progress, it's localized. So what's your thoughts on that?
So that's a fairly accurate take. The data center sort of race, we've won against China. They've got power and energy. They don't have the compute, and they don't have the data centers, and also they don't have the chips, right? So they're trying to push back and create some propaganda around this. And the data center platforms we've invested in, Vantage and Switch, They actually have a stakeholder relations team that goes out and meets with the local government. They meet with the board. They talk to the actual residents of the community and say, no, this is the way the energy economic framework really operates. No, your electricity prices won't go up because we're bringing power and battery storage co-located on the data center. No, we won't be driving up electricity prices. And here's fact, as opposed to the fiction or the NIMBYism that they're getting from some other sources of information. Yeah.
I mean, do you find that, government leadership is understanding? I think that Mr. Wonderful did a good job kind of looking at it deeper, so that way people aren't taking a skewed view of the opposition.
I think politics, all infrastructure investing is local. All politics are local. And
true.
and depending upon politicians, generally speaking, most of them are non-performing assets, right? You have politicians that their number one job is to get reelected. So as the political wind blows, if the constituents and voters say we don't want a data center in their backyard, then the politician will say, yeah, well, and here's why we can't have a data center in our backyard, right? But if they're informed as to here's the reason it's going to create jobs, and everybody has their cell phone and their computers and they want more bandwidth, more compute, but yet they don't want to have the physical infrastructure it's not in their backyard. It's literally located miles away. And I think the lack of energy economic literacy and the lack of data center and electricity literacy is leading to a lot of the NIMBYism. Right. And I think that's a lot of the misinformation that's going on. And as someone that's been to DC a couple dozen times, and I go up on the Hill, I visit with politicians, I talk to them and inform them, to your point about writing a book. I wrote that for our largest public pension fund, the state of California, because they had a lot of NIMBYism around they want to do 100% renewable energy.
Yeah.
And I said, we don't have the infrastructure to do that.
Yeah.
You're going to have issues with returns. You're going to have issues. So literally I had to go out and write a book. I handed that book out. I gave it to Obama, Biden, Trump, and I don't know whether they read the book or not.
Well, it seems that Trump especially has a battle against solar and wind. I mean, trying to change back the time with the Inflation Reduction Act under the Biden administration. So I don't know if that was just because he and Elon weren't seeing eye to eye, and he specifically, singled that out or not.
Well, I think so. So Secretary Chris Wright, Secretary of Energy, right? I met with him last year, June 26th. It was a Thursday. It's actually almost a year ago to the day.
Yeah.
And Chris was generous with his time. The chart that I developed on speed to power and energy was a result of conversation with him and some of the other industry.
We're going to share that with our viewers too.
Yeah, and I think when you look at his mandate, someone who's made their money in oil and gas and renewables like Chris Wright has, and now he's in a public service position, he looked at the Department of Energy's loan book. He looked at some of the funding and tax breaks, the ITC investment tax credits and things, and said, okay, let's not wipe the board. Let's modestly adjust things like offshore wind that take 5 to 10 years to develop, and they're significantly unprofitable and have done a lot of damage to the ecosystem biodiversity, right? Let's take a look at solar, and if these developers are speculative, said another way, 2 guys and a dog that are getting $50 million a year from the government and they've yet to develop so that's an inefficient model. And so taking away some of the tax credits, looking at some of the existing developers and operating platforms in solar and battery storage, saying, okay, these are legit operators. They have their own skin in the game and capital at risk. They have a proven operating platform. We will extend a loan for the Department of Energy's loan book, or we will provide some kind of a regulatory or tax framework where the ITC investment tax credits have been harvested. So we invested in a power platform, Invenergy, largest renewable power platform in the United States. They run a transmission line from Dodge City, Kansas. It goes all the way through Kansas City and Indianapolis. Oh, and by the way, they do wind and solar in Kansas, where you get 320 days of sunshine and the wind's blowing 182 days out of the year. Mm-hmm. So wind and solar makes sense there. Maybe not so much in Massachusetts, maybe not so much in other locales where you have cloud cover and things like that.
Mm-hmm. Well, but let me drill down into that, all puns aside. we had to incentivize oil and gas over 100 years ago. So things like intangible drilling costs so that the private sector would drill domestically. I know under Reagan in 1986, again, drill, baby, drill, because we needed to be energy independent. We are now one of the biggest producers of oil in the country. Now ours is light crude, not heavy crude, which a lot of our infrastructure runs on. But taking back or peeling back the investment tax credit, which was kind of the incentive for alternatives, wind, solar, geothermal, BESS, battery energy storage systems. Don't you think that we need to keep that private sector incentive? So I think the peel back for wind and solar as it stands now is the end of 27. So we're only a year and a half away. The others go through 2033, if that's correct.
Correct.
I'm finding that investors that understand this space, it's a great tax strategy depending upon if they're active or passive. So my fear is that it was Trump's administration just doing it out of spite, not out of logic. So what's your thoughts on that?
The coordination between Department of Energy and this administration, I think, was a bit more surgical, and they wanted to squeeze some of the speculative operating companies out by doing that, announcing the sunsetting of the ITC's investment tax credits. That creates an economic disincentive for the bad actors. They leave the space or they file for bankruptcy. And that's why there's a great distressed opportunity where we're putting money into some of these renewable platforms. But I think what you're seeing is now there's a wringing out of some of the risk-based capital within renewables. And will those investment tax credits be brought back? We'll see. And from a regulatory perspective,
so it's not necessarily the tax equity investor that's where the capital's coming from. It's probably more institutional. So you're suggesting that the ITC may not be the driver?
We're seeing it real time with institutional investment, and capital flows into renewables are higher today than they were 3 years ago.
Yeah. So going back to our investors, what would you say are some of the risks that someone should understand in investing in this sector? So let's say they are being diversified. This is going to take up some of that allocation to alternatives. So what are some of the risks that they need to understand?
Yeah, so I think if you were to look at infrastructure, private infrastructure investing, highly illiquid. Typically, when you invest in these infrastructure partnerships in private markets, the minimums are $25 million minimums with some kind of sector concentration or deal concentration. Hence the reason we created an interval fund to provide access to private institutional grade investments, and it's more of a completion strategy. With a private partnership in infrastructure, you invest in something in which there's a drawdown schedule in which it takes 3 to 4 years for the money to get put to work. With this fund, we've solved for completion strategy and solved to mitigate the J curve completely. But I think to your question about what could go wrong, what should you be concerned about, I think if you look at the period from 2009 to 2019, we had zero interest rates, zero inflation, and very, very low GDP economic productivity, right? Infrastructure did not perform well in zero rate environment, low GDP, zero inflation. Conversely, post-19, now we are in an environment with a structurally higher inflationary regime, and it's not going down anytime soon.
Mm-hmm.
Structurally high and marginally higher interest rate environment in which we see we had a forecast webinar in January, and I said we're in higher rates, higher inflation, higher GDP. And I had a couple people laugh, and they said, how do you see higher rates? We should be cutting rates. And I said, I think structurally inflation is here. It's sticky. It's going to be around for 5 to 7 years. Once it takes hold, it's very difficult to remove from the system. So rates will need to stay higher to deal with that structurally higher inflationary regime. And in terms of GDP, 40% of GDP, what's driving it is AI spending. 40%. Yeah. Right? So we're going to run this higher for longer, hot GDP growth, industrials. This is going to feel like, if you remember February of 1994 to February of 95, the Fed raised rates 325 basis points, 3.25. Equity markets tanked, bond markets tanked. And then what happened? The roaring 90s, you saw 95 through 2000, you saw equity markets take off, real estate, infrastructure, everything just sort of unfurled, but we ran it hot, inflation got hot. And so I think history doesn't repeat itself, but at times it rhymes. So I think people should be concerned about what types of infrastructure they're getting into, right? Don't try and chase after energy. Don't try and chase after renewables. Don't try and chase after sectors or niches. Find some kind of a generalist framework. Make sure that whomever is overseeing your capital has their own money in the fund or their own money investment. They have skin in the game. And make sure they've seen an interest rate cycle or an economic cycle. Said another way, there are a lot of new products out there that are cute, either ETFs or even private placements. And it's sort of someone in their 20s or maybe 30s, and have they seen a full interest rate cycle or full economic cycle?
Well, some say that, AI has rewritten the playbook. And if you listen to Elon, he's talking about GDP, 3x where we are today. I mean, so it's hard to put your arms around, old fundamentals in analysis versus, what's ahead.
Yeah. The momentum behind AI driving productivity. Interesting chart. You probably saw it a couple of weeks ago. There are more startups and more business formation today that's being driven by AI. So we're seeing more entrepreneurialism, which is, as a capitalist and as an industrialist, if they're 30, I'm encouraged by what I see. And I don't see AI as being evil. I actually have a 22-year-old, 19-year-old, two sons. One's at Cal Berkeley. The other one just graduated from Penn State. They're seeing so much opportunity for startups and differentiated companies and business models that I think there's a good interview that Satya, the CEO of Microsoft, did, and he said, AI is actually enhancing the value of human capital if you know how to use it properly.
Well, I think it's a good argument for the ability for in your structure, an interval fund, to be able to access private equity and private credit, because that what you just said, those are private companies. And I've heard that the first one-person billionaire company it's already in the skunk works. So I want to go back to that just for a moment, because I think it's a really good point to have our viewers understand this interval approach. So private credit has become one of the fastest growing institutional asset classes. How is infrastructure credit different from traditional, what I'll call middle market private lending?
So when you just look at asset-based lending, infrastructure, right? So you've got these hard assets that are irreplaceable monopoly assets with 20 and 30-year sort of contractual cash flows, right? So these are really, really good assets that you'd like to borrow against, because the collateral on those assets is amazing. And to replace those is almost not impossible, pretty close, right? Mm-hmm. But what's really notable is when you see it play out real time in default rates. Default rates in private credit used to be 4%. Now they're ticking a bit more higher and accelerating. Default rates in infrastructure debt, 0.4, 40 basis points. Wow. So you're talking 1/10 of default rate, right?
Yeah.
With physical assets that are backing these things up. And so loaning money to data centers, loaning money to cell towers, when I look at the counterparty risk and credit quality, it's a match made in heaven. And if you can get long-dated assets with a long duration of 7 to 10 years, fixed rate at 9 to 11%, we'll take that every day of the week and twice on Sunday.
Well, so you bring up a good point. And I guess I want to ask you a little bit more, because you have a unique relationship with Cantor Fitzgerald. And so that partnership between Capital Innovations, your company, and Cantor Fitzgerald, does Cantor provide access to opportunities that otherwise wouldn't be available?
So they have an investment banking, power, energy, infrastructure investment banking business. The deal flow comes from many sources. So there's an opportunity for that largely within this global sourcing mechanism. But we get 15 to 20 deals a week from multiple sources. And on average, we've tracked it. We invest in 3% of the deals we looked at. And we've looked at over 1,300 deals in the last 4 years.
Wow. Well, Mike, this has been a great conversation. I love this space. I am a big proponent of AI, of energy. So really appreciate you taking the time to talk to us and our viewers and listeners today. This has been great. For any of you that want to learn more about this particular fund, reach out to a member of the Asset Strategy team. And thanks again for watching and listening.